The best tool to evaluate mutual fund fees. I'm going to share that with you today. I cannot wait. This is, man, so much stuff is available for free nowadays. It's democratic like crazy. The information can flow down and you can evaluate your portfolio with this one tool, free as a bird, and you're going to love it. Welcome to Heritage Wealth Planning YouTube channel, my friends, the place you come to learn about how to minimize your fees, pay less taxes, and retire comfortably. We're going to talk about the first part of that, which is minimizing your fees here today. So if you like what you see here, subscribe and comments. Comments help me immensely. Even if you commented 8,000 times before, comment away. The more comments, the better off for me, because YouTube says, hey, somebody likes this guy's video. We should show it to other people, which is good. All right, so let's dive right into it. This is feex.com, feex.com, and I heard about that from my man Med Faber. I will show you his podcast. You should definitely listen to the Med Faber podcast if I can find it. Bear with me just a second. Med Faber.
Easy.
Let me pause that there. There you go. The Med Faber podcast. All right, so that's the guy's just fantastic. I think it's Med Faber, Faber, medfaber.com. And he was talking about this a few months back, and I did another video on this before, but I'm going to do it again because it's so important. All right, so feex.com. All right, so if you go here, you can go to the homepage. Let's see, all right, I'm already logged in. So basically what you can do is you can enter, and I entered, remember, we're always using Jane. I entered Jane's account. Well, it says you're paying high fees across your accounts. Reducing them can save you an estimated almost $17,000 over the next 20 years. And we have a current account that will cost, here, let's just go into it. We can show you exactly what this account consists of. And then I'll show you a way we can run your own mutual funds to see. So I have these two funds, just American Funds, Investment Company of America, which I actually am pretty fond of, and the Vanguard USA Precious Metals Fund. And they're saying because the funds are more expensive than these funds right here, we could save $13,000 from going to less expensive American funds and $3,000 from going to a less expensive Vanguard or USA fund. And then we can go to Fidelity, say, well, if we don't like the Fidelity fund, what could it do differently? And it gives you all these options. All right, so we got the spiders. We got Fidelity Total Market Index. We got Fidelity. We got Schwab. You see it. ETFs, you can change if you don't want ETFs. You just want mutual funds. Or if you just want ETFs, you can, this is just phenomenal. Schwab, Spider. I'd be shocked we don't have Vanguard in here, but I don't know how Vanguard. So they got everything under the sun here. And you say, at the end of the day, Jane, here's your fund right here, American Funds, future of balance, and they show you down here how they calculated the balance, which I won't go into, but they're using the same projected returns across the board. And they're saying, look, at the end of the day, this fund has a 0.58% expense ratio. This one right here is 0.05. And so with all things being equal in terms of performance, you're going to have $111,000 in this fund, but you'll have $124,000 in that fund. And then they even give you a year's like 9.6% on the American funds, 10.85 on the iShares, 10.88 over 10 years on the Vanguard. Don't invest on that solely, but that, it does give you something to consider for sure. And you have a similarity of 85% in terms of the holdings that they have. So it's just pretty interesting here. So that's pretty good. Here you got the total stock index. The same thing. Now, let's do click on this. How do they calculate the performance? And right down here. How does FEX determine its rates of returns? For each Lipper investment category, such as U.S. equity or bond U.S. intermediate term, FEX determines an average asset allocation by considering all the funds in that category. Then FEX assigns a category a predicted rate of return based on the following. Stocks, 5.83% average return based on academic study published by John Graham, Campbell Harvey. The equity risk premium, and you can read it right there. Bonds, 2.97 average return based on a 20-year treasury yield as of March 1st, 2018. And then cash, 1.63. So you may or may dispute that, but everything in stocks is getting that. Everything in bonds is getting that. Everything in cash is getting that. And so what that simply means, I'm not going to read the articles to you. You can go in there. We're all comparing equal. So it's equal across the board except for this right here, the expense ratio. And that's what we're doing. We're comparing the two. And then we're going to say at the end of the time frame, going back to Jane's account here from USA, we have $54,000 in there. In 20 years, she'll have $142,000 in our current holdings, But if you're going to go to the other holdings, you'd have 159,000. So that's pretty significant difference, $17,000. The question is, will all the accounts perform the same? Well, if you look at the last 10 years, no. In fact, the last 10 years, the American funds did worse than the other two, that the Vanguard or the iShares, substantially by over a point a year. Let's actually look at the USA one. I'm just curious to see. So they're only comparing one. I wonder if we did. So they're just comparing this one to this Global X Explorer. So I don't even know what that is. So I'd be hesitant to go that road. Let's see. And he says, learn how to switch to other low fee funds. How do we get adjust settings? So let's go back here. I want to try something else to make it. Okay. Insights. So James 401k. I don't like just switching from, I like when they have more than just one option. That's for sure. So let's adjust settings and see what happens there. There we go. Yeah. So let's do, at least 65% similarity. And we're going to hit that right there and close. Let's see if anything else came up for, that's it, huh? The only other fund is that global thing. That's weird. It's odd to me. I'm not sure why other funds did not come up for this area, but it is pretty specialized. But all right, so for basically specialized funds, it might be a little bit tougher to get a good mix. ETFs and best overall past returns. Ignore past returns. Let's see if that does anything. I don't think it will. Yeah. Oh, there we go. All right, finally. Okay, that's strange. All right, so now if we're going to go so if you want more holdings opportunities to switch out to, you got to hit ignore past returns. So Vanguard precious, that's what I was looking for. I knew the Vanguard has a precious metals fund. I was like, why is that not showing up? In fact, let's see here. I don't get why that didn't show up. I mean, in terms of returns, the funds are pretty similar. The USA was down 5.25 over 10 years. The Vanguard is down 7.98 over 10 years. So I don't know why that wasn't showing up. But in terms of fees, 1.22 at USA, 0.37 at Vanguard. So USA would have 5,000 less, or 5,500 less after 20 years than Vanguard would. So there you go. All right. So why do I want to show you this? So I had a person email me today. Their holdings. In fact, I love this. Look at this. It gives us a fee breakdown too. It says we're a fee grade D, and it says our goal should be here for very low fees between A and B, and we're sitting right here. So that's very high fees. That's high fees, and we're between on the backside of a high fee. So we have a high fee fund, even though we have American funds at 0.58%. That's pretty doggone cheap. It's the USA one that's really hurting us for sure, but they give us a D compared to what other similar users. Let's see here. Let's see what it tells us. Interesting. And compared to other similar users, we're still paying too much. I would think most similar users are fee conscious, so that wouldn't shock me that we're paying more than them because they're probably more fee conscious anyway. All right. So anyway, lots of different things in terms of fees lost over 20 years, balance in 20. So you can mess around with this. Anyway, so I had this person email me, said, here's some of my holdings. And like I said, is pretty, well, let's just put it this way. I think there's a lot of opportunities to make better, here we go, investment test drive, to make better portfolio decisions because he or she was paying a fee on top of the management fees for these funds. So let's try this. So I'm just going to show you a couple funds. DWS Emerging Commodity Strategy. All right, so a couple things. This is the fund right here. It's got a 0.99% expense ratio. Now, he or she is also paying 1%. So this is actually costing 2 percentage points a year for this fund. Now, is the fund good, bad, or I don't care. I just say you're paying 0.99, and we have, and let's get rid of this guy right here and go back to ignore past returns, probably open up some other funds here. Yeah, so look at this. I don't know who these guys are. ETFS, Bloomberg, whatever. DWS, I'm looking for something I'm familiar with. Bloomberg I'm familiar with, but UBS, and I'm not a big fan of that. So anyway, you can see here at the end of the day, though, she's still paying 0.99 or he's still paying 0.99 with a management fee on top of that. Now, this one, I'm not even talking taxes. We're just talking about the fund. All right, so we got 15 alternatives to that are going to be a heck of a lot cheaper. And then if you just went and bought the fund itself outright, you wouldn't even pay the management fee. All right, so that's something to think about for sure. Let's look at another one here. So that's DWS Commodity. Let's look a little bit more mainstream, which is the Fidelity Advisor Real Estate Income Fund. So I want to show you something. Anytime you see where it says I right here, that just means institutional share. So unless you are a 401k, which you as an individual investor are not, your institutional share means you're paying management fees. So not only are we paying the 0.76, why does it keep defaulting to that? I wish it would not do that. We're paying 0.76 to the Fidelity Real Estate Income Fund, but we're also paying whatever the management fee is. So anytime you see it says INST, I-N-S-T, or I is institutional shares, which means inherently it's either a 401k or you're paying investment management fee. So in this case, again, the all-in fee is 1.79, 0.79 to Fidelity and 1% to the investment advisor. It's going to be tough to make any money with that kind of fees. All right, let's see. MCIFX. Check for fees. I don't even know what this is. Convertible bond fund. And let's go back to get rid of that guy. And so, again, we have a fund that charges 0.95 for any kind of bond fund. Does not make me happy at all. I'll tell you that right now. Ugh. You're not going to make any money at 0.95 in a bond fund unless they're taking some serious leveraging or serious risk, that's for sure. Against an I, which means what I just said, institutional shares. So here's our iShares convertible bond fund that cost 0.2%. So if you want a convertible bond fund for whatever reason, you can save yourself a lot of fees. It's going to be a fifth of the fee as the Miller fund without the management fee on top of that. Again, I don't know why you'd want a convertible bond fund. I'm not saying it's bad, good, or I just don't care. But you know that you're paying 1.95. You don't want bond funds that are charging that kind of fee. You just don't. On top of the management fee too. That's crazy man talk. You can go to Fidelity Convertible Securities and pay half of what this guy is without the fee. Just all kinds of different options. I mean, you can do whatever you want. All right, so let's keep looking here. PRDGX, and that's a T Rowe price. It's got to be pretty cheap, I think. T Rowe price is 0.8. I'm thinking 0.6. Let's see what we got here. 0.64. So that's good. That's not bad. And I don't see an I for institutional share. So this is what he or she owns. He owns at 0.64 plus the 1% management fee, where you can go to Fidelity, get the total market index fund at 1.5 base. Oh, jeez Louise. We are really racing to the bottom for fees. I mean, you're paying 1.5 basis points. So you have 100 basis points and 1%. This is 64 basis points. This literally is 1.5 basis points. It's cost 16 cents on $1,000 per year. That's awesome. I just love it. I mean, don't forget, this is paying 0.64 plus 1%. So we're paying $16.77 for the T. Rowe Price fund. We could get this fund similar to that for literally 16 cents. It's insane how the race to bottom is. And of course, should be shocked. After 10 years, the Fidelity one has smoked the T. Rowe Price, 10.87 to 10.25, and that's before you take your investment management fee too. Will that continue? I have no idea, but I would not be amazed at all if this fund underperformed Fidelity Total Market Index by 1.5%. Would not shock me the least, because that's the fees. Oh, yeah. And then, of course, never mind taxes, trying to stay away from taxes. But I wouldn't even go to the mutual fund. I'd go to the ETF. So here's a Schwab large cap ETF. As you can see, we got 5-year track record, 14.37. A 5-year track record, 13.39 for T. Rowe Price. No capital gains here. Capital gains here. No management fees here. Management fees there. It's not even debatable. Does that mean T. Rowe Price is good, bad, or evil? Nope. It just means it's expensive relative to the peers that we have. All right, the last one was a Value Line one. And when I was a kid, my mom used to get this big book of Value Line stock charts to look at. I was always intrigued by Value Line, but the mutual funds aren't that good. They might be now. It's been a long time, but I just remember the Value Line stock picker was always pretty good, but then they rolled out these mutual funds. They're always underwhelming for sure. So here again, we're paying 0.86. I got to get rid of this. Why does it keep defaulting that and driving me up the wall? In fact, what I should do is just go to ETFs. Let's just do that, because we don't want a mutual fund. We want ETF. So they don't have any ETF. Oh, okay. I don't know why they wouldn't have any ETFs to exchange it into, but let's go to mutual fund. So here we got the Value Line Capital Appreciation Fund, 85% similarity. And we got, I guess that has some bonds in there. Yeah, 30% bonds. I'd want to look a little bit deeper than just these options here. We got 30% going from 13 to 30% bonds. Let's see what else we got. Anything closer? No, I guess not. All right, so I remember Columbia. They used to be pretty good. I don't know if they still are, but let's just go back to the Fidelity Puritan Fund. So we got 30% bonds, 67% stocks. The value line only has a 1-year track record of 0.86 as a fee. We could easily get something better than that for sure than this right here. Just, again, another ETF. But anyway, at the end of the day, you're paying about 2/3 of what they're paying here. A little bit more bonds, and 1-year track record. Always like, why don't we have 1-year track record? But again, institutional. You see that institutional. That means the all-in fee is almost 2%. It's gonna be tough to make any money when you're paying that kind of fee. It's just no getting around that. So anyway, Fee X, a huge fan of it. You should use it, put your own stuff in there, get a gauge of what your portfolio looks like to some of the alternatives. Should you do an alternative? Be careful. If it's an IRA, Roth IRA, annuity, anything that has the shelter of tax deferral, you can move money back and forth till you're blue in the face. If it's a taxable account, you just got to be careful because there could be some pretty significant taxes if you were to move from one fund to another. So just be advised, be careful before you do that. But at the end of the day, FeeX is a wonderful tool. I hope you use it. I think you'll get a lot out of that, and you can definitely weigh your portfolio against some of the other alternatives out there to see from a fee perspective what's going to save you money. Now, lastly, remember, they're not even using the management fee. So this guy or lady is paying that expense ratio plus a management fee. And when you add to that in, it's going to be tough to beat. So in terms of that will be tough to beat this portfolio than just a pure naked mutual fund, ideal an ETF that's low fee without a management on top of that. So hope this helps. You like what you see, subscribe, comment, thumbs up, always helpful. Go to the blog at heritagewealthplanning.com, and we'll see you next time. Thanks, guys.